Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes driving markets at the moment. We try and look at both fundamentals and technicals to get a better understanding of where potentially markets will go. Whilst I just let you have a look at the disclaimer. This week, we will focus on, as usual, what's been going on in markets to kick things off this week. We will look at kind of the amount of pessimism there is in the market at the moment and the potentials for a reversal in that, a couple of sort of charts and just other measures of the market and where it is currently. We'll then look at some of the risk markets as usual. So the S&P 500, the NASDAQ, having broken down below some key levels that we've highlighted over the last few weeks. We'll look at the dollar, of course, in this sort of initial check of the markets and how they're shaping up to start this Monday. We'll then look at a couple of other themes. We'll look at sterling, of course, a major mover in the last last week, especially, of course, all around essentially the government, the UK government's fiscal measures, and also the reversal this morning even. We'll look at cable for sure, euro sterling, and then we'll go into a preview of the other main risk events of the week. So we'll look at the RBNZ, the RBA, those currencies as well, so the Kiwi and the Aussie. And then we'll wrap up with the probably main risk event on the calendar, at least non-farm payrolls, of course, on Friday, first Friday of the month. So we always get that US employment data, and we'll look at gold as well, hopefully, if we have time. Okay. Hopefully you've taken in the disclaimer there. Let me just pull up our first chart, which you can see, which is the VIX. So yeah, markets in general, starting the week, it's obviously a challenging risk environment at the moment. That recent volatility in UK markets, especially, really adding to broader concerns about rate rises from so many global central banks at the moment. More currently, actually, the most recent risk sources adding to this negative sentiment really has been concerns around one of the major Swiss banks, Credit Suisse, and its many questions around its financial strength at the moment. A lot of measures really pointing to the potential for some sort of bailout needed for Credit Suisse. This would be a huge credit event and a huge event for financial markets if this is the case. If you've been following some of this news, there was actually an email sent from the head of the bank over the weekend, trying to reaffirm that their financial strength was not in doubt. Probably has added further to concerns around the strength. If you hark back to sort of Lehman Brothers in 2008, sort of similar type emails, and then obviously we got the great financial crisis. Not saying obviously we're anywhere near that. But there are certainly questions around this being a major risk event or the potential for a major risk event. That's Credit Suisse and just sentiment concerns around its strength, its financial strength. We also had some macro indicators in Asia continuing to weaken. And really, yeah, this points to the stress that we're seeing. We've got the VIX chart here, the monthly chart, and you can see we're elevated, we're above 30. And we also have other measures of volatility in the market, the move, actually, the bond volatility, government bond volatility measure, that's also pretty elevated as well. All adds to the uncertainty which is going on, and it's kind of fueled from many different angles, if you like. If any of you read the week ahead we put out, we mentioned about there being months where, there being weeks where months happen, if you like, and it's all down to obviously there's massive monetary tightening we're seeing from central banks. Very recently, then we've had sort of crisis management QE. We've obviously got the conflict in Ukraine, the energy crisis, utility crisis, recession risk, of course, stagflation risks, and then also then systemic risk as well, obviously with the intervention from the Bank of England, if you like, last week. Obviously, those are just some of the topics. It does sound as though there's a lot of negativity going around. These are some of the drivers hitting markets, and really that's kind of meaning that some of the macro data that we're seeing is being disregarded, as there's so many other challenges to kind of understand. Certainly that rising uncertainty isn't good for equities, of course. And even that positive blip we saw on the back of the Bank of England intervening last Wednesday, that really wasn't very long lasting. And we did close, stocks closed back on their heels really to finish last week. I think US stock markets, they notched their longest streak of quarterly losses since that collapse in 2008. Losses for the S&P 500 from June to September. So the most recent quarter, they were 5.3% down, and that means the S&P, the benchmark blue chip index in the US, that's now down over 23% for the year. The NASDAQ, the tech heavy growth index, really in the US, that reached its worst closing level since July 2020. So ended the quarter 4.1% down, and it's now down over 31% for the year. Certainly as well, then we had on Friday core PCE data. That's the Fed's favored inflation gauge, if you like, and that was still pointing to elevated prices. And we also got Fed speakers really re-emphasizing the hawkish Fed speak, if you like, of what we've been seeing lately from them, that the bank, the Fed, will stay the course on raising rates. We thought it was quite interesting that Brainard, she did say that the Fed was conscious of market ructions. And this really goes to this question we've been kind of trying to put out in some of our daily commentary, actually, about how high the Fed will hike rates before potentially something does break. It doesn't have to break, obviously. There could be an accident, or there's just other pointers in the market where but there is the potential for something breaking, that being, of course, as well, the Fed just continuing to hike rates. All this doom and gloom, as I mentioned, really points to market internals within the market, if you like, being very pretty much shot to pieces. I think there's 32% of the S&P 500 companies with an RSI below 30. 35% of those companies are at new 4-week lows. And the S&P 500 itself, that's tracking over 10%. Over 10% from its 50-day moving average. And in fact, if you get, we've actually got a chart here, which just gives you another sort of indication of market internals. Sorry, just going back to what I just said, actually, the S&P tracking over 10% from its 50-day moving average. That's taking out the big pandemic moves, actually, and it is saying that it's over 3 standard deviations from the long run average. Yes, so just lots of internals to bear in mind for the S&P as well. And this graphic, actually, this is just showing that we're sort of 20% away now from the 200-day moving average. And this is a chart from the Bank of America, actually, which really points to potentially, you can see here, we're sort of nowhere near some of these major crises that everybody's kind of talking about. But when we have to point out, when everybody's talking about gloom, doom, obviously, potentially there is the potential, the capacity really for quite a sharp snapback if there's any positivity. I think that's our point we're trying to make. This ultra bearish sentiment really kind of plays into potentially risk and reward, that sort of trade-off. As I said, this is showing, 20% below the 200-day moving average, and just relative to other points in the market that we've seen. The sort of light gray line there is sort of when we've had recessions. So you can see sort of they're probably lower than where we are, further away from the 200-day moving average in the S&P. So interestingly, potentially further to go, but also just trying to highlight how many negatives there are out in the market, how many themes there are, and then obviously then looking at some of these market internals and showing you how stretched they are as well. If we do go, let's look at the S&P actually then, which we do like to do, as you probably know. That's the monthly, but just if we go to the weekly, we highlighted this obviously over the last few weeks. So you can see really this breakdown through 36.36 that we've been pointing to after that break of that sort of trend line support there, just below 4,000. So 3 weeks of losses, and we've gone obviously now below that 36.36 mid-June support. The 200-week moving average, that's this thick black line here, is 35.89. So we're just trading on that really. Interesting because, you know, such major sort of support levels really, you'd like to think, or we are conscious of potential false breaks. So where we look as though we're breaking much further down, but then we do snap back. But I just point out, obviously, this halfway point of, which we pointed out last week, actually, the halfway point of the pandemic low and that high at the start of the year, January, just above 3,500. So 35.05 for the halfway point, which is again support if we do move lower through that 200-week moving average at 35.89. We are lower, as I say, 35.85. You can see futures here, S&P futures ticking up slightly, so above 3,600 for those futures just to start this week's trading. So just really important levels of resistance, potentially, support, but also then resistance if we do move lower. That's the S&P. Similarly on the NASDAQ, we've now moved lower through that 200-week moving average. That's at 11,178. This is the NASDAQ 100, and then the mid-June support level is 11,037. So we're currently closed below there at 10,971. As I said, really interesting juncture, watching out for false breaks, but potentially if we do go lower, then we're probably looking at levels next support around, say, 10,677 we have as a potential another or next line of support. We should then look at the dollar, of course. This is on the weekly. You can see the spike higher up to 114.77. And then on the daily, we obviously pulled back. Really, though, the dollar's found support with US Treasury yields. They bottomed out really after obviously pushing above 4%, that key 4% level, and then we sort of tracking sideways now around 3.74, 3.75% or so. That's the US 10-year Treasury yield, a big proxy for borrowing. It will be an interesting test really for the dollar here. If you think Treasury yields continues to sort of churn sideways or potentially lower, yet obviously risk sentiment is quite defensive. So is the dollar really still a safe haven without sort of those Treasury yield drivers being a key factor recently, of course, in that huge upswing in the dollar this year? So a question really to think about. And key levels for the dollar, obviously, if we look at the other majors, 145 in the dollar yen is obviously key. We tested that overnight and we're just above there now, 145.06 currently. So that's a key level, dollar yen. 145, if you remember, of course, is the level where the Ministry of Finance intervened. Well, we hit 145.70 above there, I think, before they intervened, obviously. And then also euro dollar, the world's probably the world's most popular currency pair. We're sort of bounced, and we're getting close to 98.63, which is the previous level of sort of support resistance. Now I've got euro dollar here. You can see then that nice sort of bounce from below around 96. Actually, the low was 95.35. And then we bounced, but we haven't gone above this sort of mid-June level of 98.63 that we can see there. Otherwise, then we have sort of previous mid-July low at 99.52. But the long-term trend, you can see we've still got that channel in place for euro dollar. So really we'd be looking at this rolling over again and potentially moving down towards 96 again. But it's a really busy week for US data. We'll go into that towards the end with non-farm payrolls, ISM later today as well. Certainly a strong September jobs report on Friday would continue support for the dollar, and obviously see this euro dollar rolling over potentially. Okay, let's just turn our attention to sterling. Just a crazy few days really in the life of UK assets. The trigger point, of course, was for domestic market volatility, at least, was certainly the 23rd of September's that fiscal event. It's interesting, actually, whilst I was sort of making notes, if you like, around all these events for sterling, what's been happening and where we think it's going to go. I just wrote down sort of the 4 days, actually, and I should include then today. So 5 days really around the UK, around how this sort of policy approach really became less and less coherent, if you like. If you remember a couple of weeks ago, really, and I think it's worth highlighting this and how sort of slightly unhinged really policy has become. But that Thursday we had the Bank of England announcing a liquidity reduction. So they that's via quantitative tightening, if you remember. So they were going to sell bonds. That was after the Bank of England meeting. And then the Friday we had the UK government, the new Prime Minister, the new Finance Minister, the Chancellor announcing the new fiscal measures and unfunded tax cuts. That was on the Friday. Then the following Tuesday, we had the Bank of England's chief economist signaling a more hawkish policy from the bank. But then the following day, we had the Bank of England injecting liquidity into the system. So the complete opposite of what it has said the previous week. And really a kind of yield curve control policy because of yields rocketing higher. And then obviously today we've had again a reversal of the policy, a reversal of or the abolition of the top tax rate in the UK. Just a crazy few days of policy, obviously, and then a crazy few days for markets, really. What's been happening really then, because of these different policy events, really markets have been questioning, as we said last week, actually, the appropriateness of kind of this vast tax cutting events in light of obviously spiraling inflation pressures, which are only going to be made worse by these measures. And also then we had obviously the absence, if you like, of an independent assessment of the medium-term implications for the UK's public finances. That would normally be done by the OBR, the Office for Budget Responsibility, and the government didn't get that plan when it announced its its package of measures, and certainly then since we've had some sort of backtracking or that meeting, even a very rare meeting with the PM and the OBR, an emergency meeting if you like, last week, and then the announcement that we would get this release of these plans, probably not for another few weeks actually, but that did sort of help sterling, if you like. Thinking about it generally, and we did touch on this last week, typically when you get looser fiscal policy and you get tighter monetary policy, and that should be a positive mix for the currency. But that's only obviously if there is confidence that that can be funded, those looser fiscal policies, they can be funded. And of course, in the UK, investors have had serious doubts about the country's ability to fund the packages, and really then foreign investors have shied away from UK debt due to the impact the plans are having on the public finances with the twin deficits, and markets really obviously lost confidence in the UK's economic management. Certainly one asset class to highlight obviously is fixed income. We don't normally look at this. We won't dwell too long on it, but again, I think it's worth just highlighting how big these moves were. Certainly there are big questions from markets around this part of or this market, if you like, fixed income. So this is longer dated gilts, so UK government bonds, which certainly garnered the most attention really, and the 30-year gilt yield, well, that soared above 5%, so that was a level not seen since 2002, and just on the 10-year government, the gilt, the UK government bond, some sort of context, so 95% of the time the daily move is 0.1% plus or minus, so that's 10 basis points. But on the moves we've been seeing, for example, so actually on the 30-year government bond, we had a move of 1.2% in 3 days. That was up. And then we had a 1.1% move down just in 1 day. So hopefully that kind of gives you some context of how big these moves were. And certainly then we had reports, of course, about pension funds. They were struggling under that sheer scale of the sell-off. And then the Bank of England had to intervene really and attempt to restore financial stability, and also then, potentially avert kind of an economic meltdown with pension funds getting called for margin. They were then selling gilts, and that was making the whole situation worse. So the Bank of England intervened. They announced purchases, as I've said, up to 65 billion, I think it was, of bonds, but only with a limited time frame. So purchases will be conducted up until October the 14th, I think it is. But then it's not it's not clear what happens after this date, although certainly we'll get a lot of headlines in the build up to that. And it's not really clear why that end date was picked, really. So kind of said, what happens afterwards, we don't know. But certainly the intervention has had the desired effect, because gilt yields, they've swung, as I've just mentioned. They've lowered by over 1% in 1 day, and they're continuing sort of to hover around those levels now. Another question, though, also to be answered, and complicating matters, is obviously that the Bank of England was due to sell gilts, as I mentioned, that Thursday a couple of weeks ago, under their plans for quantitative tightening, so QT, if you like. And that's now been delayed to the end of October. So we still have a lot of uncertainty. And then certainly that's sort of highlighted, if you like, by this U-turn by the finance minister, the chancellor today, this morning, the abolition of that 45% income tax bracket. And if we're thinking about that, it's kind of largely symbolic, actually, because it only represents around 2 to 3 billion pounds worth of savings. but it's kind of the optics, if you like. So it doesn't look good. It doesn't look good for the policymakers, obviously the Prime Minister, who'd only the day before, actually on an interview on major TV in the UK, had certainly confirmed that that 45% income tax bracket was definitely, she was supporting that, obviously, and then 24 hours, less than 24 hours later, really, the government's U-turn. So there is then, even though it's symbolic, if you like, as I've said, there is some focus now on other tax cuts potentially being looked at and being repealed, if you like, pulled back, stopped potentially. And then probably more importantly, there are still questions then around the size of this year's borrowing requirement by the government, and that is certainly still a major concern for the markets. The other issue, I guess, in amongst all this uncertainty is then the threat of a sovereign rating downgrade. And on Friday, actually, we had the S&P shifting the UK outlook to negative from stable. That was in an unscheduled announcement late Friday. So again, uncertainty around the UK's fiscal position, around its finances generally, if you like. So this week, moving on, hopefully, or just generally around sterling, we do hear from several MPC members, so members of the Bank of England, the Monetary Policy Committee, and markets will certainly be watching out for any clues on how the MPC plans to respond to the fiscal expansion, of course, and its views certainly on the recent volatility that we've seen. I think where rates were potentially, I think back on the 26th of September, markets were expecting rates to increase by 2%, 200 basis points actually by year end, I think it was on that date. I think now we've had a big pullback in that. I think less than 125 basis points of rate hikes are expected now into November and year end, but certainly by November. So a big pulling back in rates, but also then we have seen this move higher in sterling. Let's now look at cable. So this is sterling against the dollar. Technically, you can see, well, going back now, we pointed out this bearish engulfing candle there. We said that was looking bleak technically. I think we actually mentioned that there was no obvious support actually for sterling until the sort of early 1985 low at 105.20. And we'd only just broken 114 then. So obviously we had a massive move lower. The 103.56 we have as the low, that spike low last week. But then obviously since then we've had this really decent bounce back, if you like, higher, and we're sort of back to these levels pre the mini budget, or what everybody's calling now the fiscal event. We're back to sort of those levels really, so quite encouraging. But potentially, where do we go from here? Tough, really. Certainly, the events, especially today's events, probably have eased that risk of cable trading to sort of 105, probably below 105. They've eased those risks really for now. And really, does it mean that the Prime Minister and Kwasi Kwarteng, the Chancellor, the Finance Minister, are they sort of showing some sort of respect, if you like, to financial markets when considering policy options? That is probably a question potentially further out, but at the moment then technically, yes, we've still got to get above what we think is the major resistance level, 114.09. We're just pulling back here. That's the pandemic low. So that support now acts as strong resistance to any move higher. And we kind of think this long-term downtrend really that will assert itself again if we can't push above that 114.09 level. but certainly volatility is very high in sterling at the moment. So much uncertainty around it. As I've said, we get the MPC speakers, some of those, and then also we get obviously Prime Minister Truss speaking on Wednesday. We kind of think you have to bear in mind that it's the Conservative Party conference, so she will kind of be playing to her sort of devout supporters, if you like. Whereas we know that some of the MPs, a lot of the MPs didn't actually vote for her in that first round, in those first few rounds of voting for the leadership of the party. But a lot of those MPs or some of the more prominent ones are not actually at the conference. And then we've heard from quite a few of them, or some of the more important ones, obviously yesterday, who obviously had their doubts around that some of these tax cuts. And then we've had that turnaround, that U-turn this morning. So a lot of volatility still. We did mention and we did point out euro sterling actually last week as well. If we just point out, you can see then that spike really highlighted on the monthly chart for September, massive spike up to 92.77. And if you remember, we sort of highlighted the fact that above 90, 91, and definitely 92, we haven't really hung around there for that long. And lo and behold, yeah, we closed nearer to the open than that massive spike. So sort of quite bearish in a way. And if you look then on the weekly, you can see, yeah, the spike lower, the spike high, sorry, and then this move down. So quite a few days of losses now, and we've headed into that mid-June resistance support it was, and now sort of resistance and now support really. That level 87.21. We hung around there before that big push higher, and then now we're nestled right on it really. 87.25 we're trading now. So be interesting what happens here. We've got that level there, 86.91. So just below sort of 87 as another support level. Before then, potentially we move down towards sort of 86.50 or so if we do break lower. Otherwise, that acts as support, and then we push on sort of above 87. That's in euro sterling. Okay, other risk events really to look out for on the calendar. We mentioned the RBNZ and the RBA. Just bear with me, I'll just pull up the Kiwi chart, which is here, of course. So the RBNZ, that's the central bank for New Zealand. Well, that's expected to deliver its fifth consecutive 50 basis point rate hike this week. That would lift the cash rate to 3.5%. Money markets, I think they're pricing in around an 80% probability of this kind of move, and then a 20% chance of a bigger 75 basis point increase. The bank, they delivered a hawkish rate increase last time when it raised rates for the 7th time in as many meetings since the start of the hiking cycle. And it also increased its projections for the bank rate and also for inflation. Markets, they see the peak in rates above 4.1% now. But at its last meeting, as I said, the bank, it raised its projections for the OCR, the cash rate, and inflation. It noted that conditions needed to continue to tighten and really agreed that the maintaining of the current pace of tightening, that was the best option for the bank to meet its objectives. The governor, Governor Orr, he also flagged further rate increases as getting rates to 4% really would buy comfort for the policy committee. But he acknowledged that also that the tightening cycle is very mature. Yes, as I've said, bank markets, they expect rates above 4.1%. Some local banks in New Zealand, they've actually lifted their forecasts to 4.5%. And that would mean 3 more 50 basis point hikes at this meeting, and then in November, and then in February. That would take us to 4.5% or so. Recent developments for the economy. Well, really, we've got the risks of stronger and more persistent inflation. That's essentially down to the weakness in the New Zealand dollar, in the Kiwi. It's been a lot lower for longer than many analysts would have thought, and that really adds potentially to the pace of inflation in the year ahead. The economy is kind of overheating, really. It's proven to be more resilient in the near term than many thought as well. And this kind of risks inflationary pressures growing, getting greater. Yes, we'll see what the RBNZ has to say. The expectations are that it repeats actually that rates will continue to rise at pace. And they'll signal a higher peak rate for the cycle. As we've said, local analysts, they've sort of put their peak rate up to 4.5%. Currently, it is 3.5%. As regards the Kiwi, the dollar, Kiwi dollars, definitely been at the mercy of external forces, really. I think one bank said it's like drifting, the Kiwis drifting like a cork in the tide. And even with this hawkish RBNZ policy, that certainly it should offer some degree of support, but really it's these global forces that are a big driver of Kiwi dollar at the moment. We are oversold. You can see on the daily we're oversold, but we're sort of pulled back and we're consolidating around the lows. We had 7 straight days actually of losses. So certainly this oversold nature sort of that's pulled back slightly, but we're still, as I said, hovering around the lows. The lows from last week actually 55.64. So potentially we might see a pullback, but really we need to get above probably 57.54 really to slow this downtrend. Otherwise, this potentially looks like bearish consolidation. But potentially we still need to ease these oversold conditions. So the RBA, that's after the RBNZ, similar chart. The RBA, they're expected to hike rates with a 50 basis point hike. That would lift the cash rate target to 2.85%. Although money markets actually, they're sort of nearly even in terms of pricing the chances of a 25 basis point hike or a 50 basis point hike. I think analysts more convinced that they go 50, but markets kind of coin toss, I think, around 35 basis points, I think, priced in. As a reminder then, at the last meeting for the central bank, the board was committed to doing what was necessary, obviously, to ensure inflation returns to target. Expects further increases in the months ahead, but the bank said it wasn't on a preset path. Governor Lowe, more recently, he stated that at some point they will not need to hike by 50 basis points, and the central bank is getting closer to that point, and they're closer to normal on rates, but they're not quite there yet. He said rates are still too low right now, and they'll consider tightening by 25 or 50 at this meeting, and those options were discussed last month. So increased hints really about a possible slowdown. They've sort of spurred some expectations that the RBA, they switch gears. Regarding latest data, well, the scope for the RBA to stick with that sort of higher 50 basis point rate hike, really, that's sort of backed by the GDP, that strengthened. And although jobs data missed slightly, the unemployment rate remains firm. Still below 4%. And then Australia's monthly CPI, that showed inflation still elevated at 7% in July, 6.8% in August, actually, and that's more than double, of course, to the higher end of the 2 to 3% RBA target. We've also got the labour market, that's the tightest in 50 years, I think. And so peak rates really seen around 3.5% or so. So that would mean a few more 25 basis point moves potentially from November to February. Just looking at the Aussie then, again, sort of buffeted, hit by external forces, really similar to the Kiwi. You can see on the weekly chart, actually the break of the mid-July support at 66.81. And then we've hit 2-year lows, really, well under 64 now. That low was actually 63.63. And we're consolidating around the lows, sort of easing those oversold conditions, but consolidating kind of bearishly, it looks to us. We would probably need to get above 65.38, these sort of levels here, just above 65, to slow this downtrend, really. And then, as we said, that low of support is at 63.63. Okay, just turning finally to non-farm payrolls very quickly. Consensus expectations there for a, let me just pull up the graphic actually. Yeah, the graphic here, this gives you sort of the general numbers. Consensus for 250,000 in September. That compares with last month's 315,000 analyst forecasts. They range between 175 and 350. Jobless rate, that's projected to remain unchanged at 3.7%. Again, forecast range from 3.6 to 3.8%. And then average hourly earnings, so wage growth, that's forecast to have risen by 0.3% month on month, September, probably around 5.2% or so. But the report will be digested really to help gauge the Fed's reaction function for its November meeting. If you remember the latest dot plots, they have signaled another 75 basis point hike in November. And markets currently, they have, well, a 54% chance of that happening. So that's come down actually from sort of the mid 70s, I think about a week ago, but potentially a coin toss now for that 75 basis point move. So really adds importance to non-farm payrolls, to the headline figure. Would probably that 250,000 estimate will likely mean a sort of modest slowdown in employment actually, but that probably doesn't deter the Fed from these rate hikes, certainly, although it may suggest a pivot to a slower 50 basis point increment if, say, we got a print well below that 200,000 mark, probably. And certainly then that would put a brake on the dollar advances. Particular attention we think should be paid to the wages component, because that will affect then the inflation narrative, of course, after the hot CPI and also the PCE figures we got recently. And then that comes ahead of the September CPI print that's released next week on the 13th of October. Expectations for the headline to still be above 8%. So potentially, if we do get average hourly earnings possibly ticking lower, then that will really pour focus on that CPI print next week. But certainly, well, stocks, they would probably find buyers on a sub 5% print really for the annual figure of average hourly earnings. The flip side then, if we do get a solid report, of course, that risks worsening the rout really in, or the sell-off in equity markets, in bond markets then, and that would push the 10-year Treasury yields obviously above 3.75% and potentially back to 4%. If we do get a really solid blockbuster report. It's interesting that we have seen the more frequent initial jobless claims, that weekly data. We've had 10 straight weeks actually where claims have come in less than expected. Where actually we hit the lowest levels since late April. And recessions, if you think about it, they usually happen when these claims, they go up and they're not going down, which is what we've seen. So interesting there, and there are calls for quite a decent number by some analysts in the headline, potentially in non-farm payroll, which is released on Friday. Before that, we get, as I said, the ISM data that's out today, the manufacturing, and then we get services on Wednesday, and that will provide some color, further color about the labour market in September. We get the initial jobless claims, the weekly data on Thursday, and that potentially coincides actually with the official, the BLS jobs report data. And we saw that slight uptick actually to 213 actually from a revised low of 208. But as I said, we've had 5 straight weeks really of quite decent jobless claims numbers, really, and the opposite to what we'd expect in a recession. We also have I think 14 Fed speakers this week, so potentially hard to see too much change from their quite hawkish chatter, really. There has been some cooling of inflation expectations amid the tighter financial conditions, really. But really, if we do get any acknowledgement of these moves, then that potentially is positive for risk. Just on non-farm, just going back, actually, you can see a chart here. The unemployment rate, obviously, near these 50-year lows, actually 3.5% it was actually, and we're potentially sort of 3.7%. And then you see that slight slowing down in job gains, really. 250,000, as I said, is the estimate, but the slowing down from where we've been, and that potentially does happen as we get these tighter conditions. Let's finally touch on gold if we can. Just bear with me 1 second while I pull up the chart, which is here. Yeah, so gold really, technically then, we did actually highlight last week this halfway point. Actually, this is the halfway point from 2018 lows up to that high in August 2020, and the halfway point was 1617. And last week, actually, we got to 1614, and then we sort of bounced off that fib level there. But we're still below that sort of critical juncture, if you like, that we've highlighted, this sort of support and now resistance around 1676, 1682, being these lows from March 2021, and then August 2021, and then July of this year. So key level there of sort of resistance, if you like. We did try push above it, 1659 actually, sorry, 1675 where we got to on Friday. But key level there, interesting juncture, but we're still obviously in this long-term bear trend. Potentially, if we do roll over, and that does its job actually of resistance around 1676. Okay, we've covered a lot, we think. Of course, please follow us on social media, follow our daily commentary, and lots to look out for this week. Non-farm payroll finishing it off on Friday, but a lot in between as well. Good luck out there, and we'll speak to you next time.